Real estate investors, would you buy this house for $98,000? Follow along as I break it down. I found this deal in a local Facebook group. They have it priced at $98,000. They're saying the ARV is $188,757. A very strange number to come up with for an ARV. But in any case, they give the full address. A lot of wholesalers won't do that publicly out of fear that someone's going to come in and try to steal the deal from them. The size of the property is 1,212 square feet, and the repairs needed, they're saying, includes foundation and flooring with a conservative estimate of $37,000. Then they go on to say that comps in the area are selling between $172,500 and $232,535. But of course, we already know that they're estimating it's on the lower end of that spectrum at $188,757. One of the first things that I do when I'm looking at a potential deal is look at the tax records. So I have Realist pulled up. I have access to Realist since I'm a licensed real estate agent in Texas. And it shows a 2-bed, 2-bath home. It is 212 square feet on a 6,000 square foot lot, built in 1950. You can see it's an out-of-state owner, but also something very interesting that I see over here is it's an active listing. And when I scroll down, I can see that this is an active listing. It was originally listed for $110,000. Now it's listed at $99,000. They dropped the price as of November 15th, and this is the agent that has it listed. So this tells me that the wholesaler either has a contract with that listing agent, and it must be a much lower price, and then they're going to try to make a spread with some other investor doing a double close or maybe an assignment of contract. Or they've just had some conversations with the agent. They don't have a contract, and they're just seeing what other investors out there that would be interested, and then they're going to go try and get a lower price later on. One of the two. So in this situation, am I going to talk with the person on Facebook or the agent? I'm going to talk with the agent. It's listed. I'm going to go look at the actual listing. I can see that the pictures here are the same pictures that were posted by the wholesaler. So I can tell from the pictures that the roof looks pretty old. Doesn't necessarily mean it needs to be replaced, but home in the 1950s probably does, especially if you can tell with these very low quality pictures. If the roof is already standing out, probably is going to need to be replaced. The siding unknown here. We can definitely see is going to need painted at the least, but almost certainly there's going to be some siding work. There's going to be some wood rot. Looking in the inside, a lot of trash haul off if the sellers aren't going to take this out prior to closing. Sheetrock work, painting, and that's about all we got. If we scroll down, not a lot to go on. They're saying it needs some TLC, creative touch, and it's going to be a personal project for someone who wants to remodel it. So how much would it actually cost to repair this property? It's hard to tell from the pictures. There's just not a lot to go on. But what we do know is they said it needs foundation work. It looks like the roof needs to be replaced. And we have the square footage. We know the age of the property. And anytime there's foundation work, there's probably going to be plumbing work as well. So I'm going to go into the calculator here directly on our website, divestagents.com/calculators, put in the square footage, go to a moderate scope of work. We know that the roof needs to be replaced, foundation, and anytime that there's foundation work, I'm going to assume that there's plumbing. Unless it's just very, very minor and the actual parts of the foundation are nowhere near plumbing lines, maybe I won't do plumbing. But for a home in the 1950s, I'm definitely going to put in some plumbing. There's a possibility it could need some electrical, could need some siding, probably needs an HVAC as well. Actually, I'm going to go ahead and throw that in there just in case. Calculating estimated cost. So it's given a range of $39,180 to $57,240. Obviously, these ranges really depends on how much and how extensive you're going to go into the remodel, but it's a decent range. They estimated $37,000, which is on the lower end of this range. All right, for holding costs, loan payments will calculate automatically once I put in the loan amount here in a minute. Let's go check out taxes. If we look at the tax records, we can see in 2023, it was $2,055 and went up about $150 or so, maybe $200 from 2022. So we're just going to assume another $200. I should kind of round up a little bit to 2,200. HOA, almost certainly is no HOA in this community. No HOA, so we're leaving that blank. No other cost. As far as utilities, when we're doing the repairs for a monthly amount, I'm just going to put $250. Actually, let's do 250. And insurance. So I'm gonna put about $1,800 for a builder's risk policy here. Right, we got no HOA, no other cost, holding time. So generally, I estimate about $7,500 to $10,000 per week in repairs. So it would probably take about 4 weeks to do the full remodel. Now it depends on the days on market to sell it. How long is that going to be? Without going in and doing a full deep dive into the comps, I'm just going to put a baseline of 3 months. All right, now the sales price. 28,757, that weird number that they gave for the repairs. It's going to cost 6% in commissions, but I'll leave 6%. Even if I do it, got to pay myself for that work. Closing costs, it's going to be about roughly 1% of that. Almost certainly there's going to be some buyer credit. Buyers are going to want credit or some help to get the get their out-of-pocket expenses and down payment and all that stuff at closing as minimal as possible. I'm going to leave that blank for now. Home warranty, give $500 for warranty. No staging, probably going to be some additional repairs. Going to leave that blank for now. Given a net proceeds of $174,392 after the sale. All right, something we don't have yet is the loan amount. If you're going with a hard money loan, they're going to loan you about 70% of ARV minus repairs. And really, they'll loan you the full 70%. They're just going to hold back the repair amount, which we have $37,000 here. So that would give you about $132,000. 13% interest, 3 points. Interest rate could be 12 to 14%. Points could be 3 to 5. But this is a fairly decent estimate. Of course, you'll know in your local market. Just talk with hard money lenders on how much they charge. But if we do that, we can see our total acquisition cost is $141,310. Total loan amount is $132,000 even, which means we have to come out of pocket. We have to bring a check to closing for $9,310 to buy this house. Now, if you did get a hard money company that was able to give you 75%, or maybe more likely a private money lender that was able to give you 75%, well, now you only have to come to closing with $95. So $100 bill, get some change back, except for title, they don't accept cash. So, and you can see how over here where the monthly payment changes based on the loan amount, but also based on the interest rate you have. All right, and the points. That's points over here for lender points. And there's no fees, so if your lender has processing fees or anything like that, you would add that there. All right. So let's just say you got the max loan, so you don't have to bring as much to closing. Now you have a net sales proceeds. If everything goes right, you don't need to give the buyer credit. You don't need to pay for any additional repairs. If everything goes right, your net profit after you sell the property, you buy it for $141,000 all in, and your holding costs are $6,349 because you actually sold it in 3 months. Your net profit was $26,000, or it would be $26,988, giving you an 18.24% annualized ROI, 14% profit margin. Would you do this deal for a 14% profit margin? I would not. At a bare minimum, I want 15 to 20% at a bare minimum. And you may wonder, like, what's one little measly point? It really is. This is the best case scenario. And in a best case scenario, assuming repairs are online, which we already know that was below our range, and almost certainly it's going to be much higher. And a best case scenario, that the time that actually sells for what we're estimating, everything, we're only making $27,000. Very risky. And you can tell by looking at the sensitivity analysis. So starting with price, hey, if you're off 5% on the sales price, that $27,000 goes down to $17,500. You're off 10%, goes down to $8,000. And being off could be you misjudged it, or it's just so competitive because other homes are on the market, so it just takes a lot longer, and you have to drop your price a lot. It could be a lot of things. The market changes. Now, what about your hold time? What if your 3-month hold time ends up being 5 months? Well, now it's going to, and this is really a compounding effect here. If it takes 5 months and you're off by 10% on the price, because maybe it takes 5 months because it's slow and you have to keep going on price. So it takes longer, which adds cost. And then you also lower the price, which decreases the amount of income you have. You can see how this can really eat into your profit margin quickly. So if it takes 5 months, your baseline goes to $22,755. And that's if you're still selling it at full price, your original price. So you lost $4,000, but if you lost $4,000 and you had to sell it 10% below, now you're only making like $4,000 in profit. What about repairs? So what if your repairs cost 10% or 20% more? You can see how it really eats in. And 2 or 3 of these things, if you're off, can destroy profit and can quickly put you in the red. That's why I would not do this deal. But would you do this deal? Let me know in the comments.